Hey there, 𝗕𝗵𝘃𝗶 with another installment of Capital Markets Investor Relations in 2 minutes or less. This is our 4th video in our series on building and optimizing financial guidance as a public company. And in today's video, we're going to talk about financial guidance key considerations. And what I want to start with is this idea that for a lot of executives at public companies, financial guidance is fraught with fear and anxiety because of rules. And there are 2 rules that drive this fear and anxiety. The first are external rules. Think the rules of SEC, FINRA, PCAOB, and then there are internal rules, the rules that we impose on ourselves that drives anxiety and makes us question, are we doing this right or are we making a mistake? And this is where the idea of guidance as the art of finance comes in. Guidance is really this ability of translating the detail that is internal operational finance and zooming out to the summary level, which is capital markets finance. So let's get into financial guidance equaling the art and the science, the combination of both sides. And when you think of the science is the numerical data comprised of forecasts and scenarios. There's going to be a lot of different ones. Data internal to the company that is not likely public. And then third, there's going to be a wide range of outcomes and expectations involved in these scenarios and different forecasts internal to the company. And so this gets us to the second piece, which is the art of financial guidance, which the art of financial guidance is simply the idea of summarizing amorphous financial data. And why do I say amorphous? Because it's constantly changing. You're starting at the highest levels. You need to have a simple summary of all of this internal minutiae detail of your financial operations. But then you need to be able to summarize that in a simplistic and digestible way for investors. And that's ranges, ranges, ranges. You always want to speak in ranges to investors, is the way you summarize that internal detail. And then to really bring it all together, the range you provide needs to contemplate and be mindful of all of the scenarios that are in your internal operational finance. So the range needs to be large enough to contemplate all of those scenarios and outcomes. So let's get into this idea of where does it typically go wrong? Why does guidance go wrong for most people? And it starts with the idea of you give a spot number versus a range, and so that backs you into a corner. Secondly, you may be too aggressive with your numbers instead of walking up your numbers throughout the quarters in a given operating year. And then third, if you give your budget as your guidance, you've made a huge mistake. Your budget is never your financial guidance to the street. And so lastly, why is this so hard for public company executives? Well, again, executives and accountants don't think in terms of scenarios. They think in terms of hard numbers, hard outcomes. I've calculated a number. And this requires a certain level of strategic thinking that is typically taught in capital markets. It's more of a capital markets finance muscle than, say, an accounting or internal operational finance muscle. And the idea here is you want to be preserving the optionality of your guidance. So what do I mean by preserving the optionality? It's this idea that you want to give ranges and forecasts and summaries to Wall Street so that you don't have to back yourself out of a corner by destroying your stock price. And so we'll close with the key learning, and that's just simply the idea that guidance, and the reason guidance is mostly art, is because you have to translate the detailed internal operational finance and take that to a summary level, which is capital markets finance. As always, thanks for watching.